And I think this is another one of these uncomfortable facts that gold bugs don't like to think about. And I know this because I was one of these gold bugs. In theory, on the charts, gold may look like it did well. And there were periods, believe it or not, when it did do well. The period from, say, 2006, 7 to 12, 13. Well, around 2011, I think, it did pretty well around that time. And yet, if you're actually buying physical gold, if you're taking delivery of physical gold, you're paying such an enormous premium to be buying it. And then when you're selling it, you're also paying a premium. And people like me who are pretty ideological about it might like to forget about this and not calculate the numbers. But if you think about it from a practical perspective, this is what money is about. And when you read Carl Menger, what makes money is the fact that it is the good that has the smallest bid-ask spread. It's the good that when you take it to the market in large quantities, if you want to get rid of it in large quantities, you're not going to have a significant impact on the market. It's the good where you can have the least significant impact as a seller. So if you have a Van Gogh painting, there's only so many Van Gogh paintings out there. So if you choose to make Van Gogh paintings your store of value, and you're some sovereign wealth fund that holds $1 billion of Van Gogh paintings, and then you decide that you want to sell half of these Van Gogh paintings so that you can buy some other thing, so you need to raise $500 million. Well, if you drop $500 million of Van Gogh paintings on the market on a weekend or a weekday or a week or a month, you're going to seriously depress the price of Van Gogh paintings. And the same is true for real estate. If you invest in real estate and then you drop a large amount of real estate properties in a certain area on the market, that's going to bring the price significantly down. And the same is true for pretty much everything. And money is the one good that has that the least. Money is the one good that resists this the most, because it is the one good in which people have increasingly large cash balances. And realistically today, that's the dollar. And that's the dollar by a country mile. I'm not going to go ahead and give it the honor of saying there is no second best, because it's not true. There are second bests. But I think Bitcoin is catching up. So Bitcoin's spread is declining significantly. So 5 years ago, if you wanted to buy Bitcoin from a dealer, there was a bigger sort of spread that you had to pay a few percent extra premium in order to buy it, and then you had to sell at a few percent extra, a few percent less in order to get rid of it. But that keeps shrinking because the liquidity keeps growing and growing and growing. And of course, because it is one good that is fungible all over the world and it's easy to send, that makes the market's liquidity grow more and more.
Yeah, and it's because I talk to institutions sometimes or large investors, and we can see the liquidity, like that saleability and liquidity goes up over time. And what's interesting is until it's large enough, it doesn't even interest the next level of buyers. Like, when Bitcoin had $1,000 worth of trading volume, someone couldn't just throw $1 million in there. When it had $1 million in daily trading volume, you couldn't just, Michael Saylor couldn't just throw $1 billion into it. When it has billions of dollars of trading volume, there's still $1 trillion of pools of capital, like giant insurance funds or sovereign wealth funds or large, very large endowments, and it's still a small market for them. They'd have to be careful about moving the price. But it's like the more liquid it gets, the more interesting it becomes to these larger, potential cash balance type of entities or investment entities. And so you can kind of see it just over. That's another. It's not just price in which it monetizes; it's that liquidity over time, and we kind of just see that stepping up more and more. I think that's a really big factor, and that's also, that's when people talk about kind of the other altcoins. Again, it's like they're like basically Van Gogh paintings. They're all these little tiny mini pools of liquidity, and whereas when a money gets more liquidity, that liquidity makes it better money. When I talk to gold enthusiasts, I think that's a key thing. Basically, I think emphasizing the portability is at least in my discussions or my writings, I find that emphasizing the portability matters. Like, for example, I go between the United States and Egypt every year. If I'm in Egypt, I can't access any gold I might have in the US. If I'm in the US, I can't access any gold I might have in Egypt. Good luck bringing any significant amount of gold out as a bearer asset. And the way that most people hold gold is they'll just hold it in like an ETF or something. But then you're in the realm, if you don't care about the bearer properties, which with gold is kind of hard to do, because if you want that verification premium, you're going to pay a premium for the smaller, more verified coins. But if you don't care about the bearer aspect of it, like the fact that you can self-custody it, if you're going to put it in ETF, well, now you're competing with like Apple stock. Now you're competing with, the monetization of savings is people can say, well, I can either choose gold or I can choose the S&P 500. When you look at, say, Apple stock, it's a big profitable company. They actually reduce their shares every year because as long as their business is successful, they keep reducing their shares. And when people can just buy like a percentage of their national equity, so they don't have to rely on one company risk, they can just buy 500 of them. That is a big competition for gold, because if for people that don't care about the bearer nature, another 3,000 tons of gold are coming to market every year. That's supply that has to be absorbed. The S&P 500 has been able to hold its value better with dividends included compared to gold. And so between the two factors, that if you take gold in your possession, you're going to have all these frictions. If you don't take gold in your possession, then you're competing with a sea of other monetizable assets. from which it's one of many. And so it's not surprising that its overall monetary premium has kind of reduced as a share of global assets over time. But Bitcoin fixes a lot of that. Bitcoin has you can it's a bare asset with zero terminal supply, and that's just it's basically it's something that stocks are going to have a much harder long-term hurdle for outcompeting. So it's a much more compelling case for your savings. The bearer nature of it is way easier, and then you basically save up optionality. So right now a lot of institutions or just large investors will view Bitcoin as like a risk asset, but I think the smarter ones also view it as an optionality asset. That if you hold Bitcoin, you now have access to global portable money. You can make unsensible transactions. You can bring your wealth with you if you want to change jurisdictions. And so just across the board, the way it ranks in all these different metrics of problems it can solve is just it's very, very high. And the past kind of 50, say the past 40 years or so of this, like let's say the modern era of declining interest rates, ever higher valuations, that's been a very difficult environment for gold to operate in. And what Bitcoin is I think just a far more suitable competitor. And it just comes down to continuing to test it, see if it survives any possible attack thrown at it. And as it does, it just acquires more liquidity and pulls more and more liquidity towards it, which then opens itself up to the next level of potential buyers.
I agree entirely. I think you share my frustration, I think, with the common criticism of Bitcoin, which is, well, Bitcoin has not won yet, so clearly it will never win. Bitcoin has not overthrown the dollar yet, so clearly it will never overthrow the dollar. And it's just, I find this to be extremely short-sighted. I think a lot of fiat economists and I should say fiat adjacent economists, people who might pretend to be Austrian or sympathize with Austrian ideas or pay lip service, I should say, to Austrian ideas, have this idea that, well, I saw some poor people in a hyperinflationary country and they were using dollars. Checkmate Bitcoin. Bitcoin is never going to recover from this. And of course, I mean, the dollar is the biggest monetary network that has ever existed. You're not going to dethrone it in a day. You've got hundreds of trillions of dollars in liquidity in dollars and dollar instruments, second layer and third layer dollars out there all over the world. You can't just have the entire world switch from this to a new form of money overnight. But the question is, in what direction are we heading? And we see it. We see bigger liquidity, and bigger the liquidity on Bitcoin, the more feasible it becomes for people to switch to Bitcoin. And it's very limited static thinking when you just can only see it in terms of where it is right now. But as you described, as the liquidity grows, it becomes more attractive. And the liquidity has been growing enormously quickly over the last 15 years, and it's likely to continue to grow. I think you need to offer a very compelling case why the trend of the last 14, 15 years is going to reverse. And I don't think anybody has succeeded in offering something like that. So people like George Selgin or Nassim Taleb may have offered explanations for why they think it's not working or it's not worked or it won't work. But they don't have anything substantive to say why the trend of the last 15 years can't continue. And the reality is, if over the next 15 years, Bitcoin has 10% of the annual growth that it had over the past 15 years, it becomes bigger than the bond markets of the entire world. It becomes the most liquid, largest, most saleable good in the world. It doesn't have to match the performance of the last 15 years in order to win. It needs to just not shrink in terms of its liquidity. And I think, given the fact that we don't see reasonable attack vectors where the thing can be compromised on a technical level, it's a pretty bold call to say that this trend is going to reverse. Wouldn't you say?
I agree. And I think another thing we share in common is the importance of cash balances more than just medium of exchange. The reason that's kind of complex to talk about is because they feed on each other in a certain way. So, for example, ironically, people will criticize the Lightning Network as being small, not handling a ton of volume. But I would make the argument that I would hold maybe less Bitcoin today if the Lightning Network didn't exist, because the existence of the optionality of the Lightning Network increases the value, my perceived value of my Bitcoin, because it increases the overall usage of my Bitcoin should I ever want to, right? So at the current time, I'm not in an environment where I normally have trouble making payments. It's just not a problem for me. It is for some people in some areas, but it's just not a problem for me. And I'm in an environment where every transaction would be a taxable event, just because of the currency monopoly I exist in. And so the way that I perceive Bitcoin is that the convertibility is more important than the current number of goods and services that are actually happening in Bitcoin. So, for example, if the only thing I could ever do with my Bitcoin is take it to like one of 8 exchanges in the world and convert it for fiat, that would not be a very useful system to me, because I would say, well, I mean, government's going to shut down these 8 entities and it would be useless. The fact that there's tons of exchanges in the world, a number of merchants that accept Bitcoin, a number of just people that I can just convert it to multiple different currencies, and then I'm in their like arcade token, I'm in their little like currency monopoly with my bare asset. There's multiple things I could do with it. So I think that a thing that gets left out of the technical discussion, or people that are too focused on the medium exchange element, is that they don't consider the importance of optionality.